Soaring stock markets sound like an unambiguously great thing, but that's not always the case, says our guest today, Ryan Dintz. Ryan is our cryptocurrency and tech expert, and in today's article, he argues that investors need to be worried about something called a market melt up instead of a market meltdown. Ryan, what could possibly be wrong with stocks going to the moon?
Hi, Nick. How are you? Yeah, look, you're right. Stocks going up doesn't sound like a bad thing, but in today's piece, I sort of tried to frame it as a catastrophic melt up. And what I meant by that was that the prices of everything isn't necessarily good if if it is happening in a situation where economic circumstances are bad. And what I was getting at was ever since the GFC in sort of 2008 and probably before that as well, central banks and government policymakers have always reacted to various points of economic crisis by essentially money printing. And look, money printing is a catch-all term, and I don't want to define it too loosely, but it's different ways, different methods they've got to inject money into the economic system, which tends to have the follow-on effect, sorry, of supporting asset prices. Now we saw that again in COVID. If you remember the COVID in 2020, there was a short, sharp crash when COVID hit, and everyone realized the economy was going to come to a standstill. And yet, if you remember the 2 years following from that, markets had a massive melt up. And this was at a point, remember, when people were sitting at home, businesses were getting paid not to work, economic activity was coming to a standstill, and markets were going on a crazy run. And you think about it, how does that make sense? It doesn't make sense from any economic fundamentals. But what was happening then, and what I think might happen shortly, is more money was getting injected into the system. That money finds its ways into markets. It finds its ways into property markets, stock markets, other assets like gold and Bitcoin. And it does that because if you think about it, the denominator from which we define our wealth is the dollar. You know, we say how much dollars. It used to be when I was growing up, oh, if you were a millionaire, that was the aspiration to be a millionaire. Now, there's a lot of millionaires in Australia these days, and it's not necessarily as rich as it once was. I'm not saying it's poor by any means, but being a millionaire doesn't mean you can sit back, retire, and live your life comfortably anymore. And so the point I was making in today's piece was that things are looking shaky, and yet depending on how central banks and governments react, we might see markets move up even as things get worse. So that was sort of the broad point I was trying to make.
Yeah, we'll get into why you've identified now as the key risk in the next question. But first, I want to dig into this a bit more. It feels like central banks are forcing everyone to invest just to try and maintain some purchasing power of their savings. And that's fundamentally changed the game, right? Because you can't just put money in a savings account anymore. You've got to do something with it. And this has sort of
Yeah.
shifted everyone's behavior around. So tell us more about that.
Yeah, so that's absolutely correct. Now, everyone seems to measure cost of living using CPI, which is the broad term of inflation. Well, that's the economic term. You probably have some qualms with that, Nick. But the CPI level, usually they try and aim between 2 and 3%. And so, in theory, you need to grow your money by at least that in order to keep up with the cost of living. Now, a lot of people think that that is a very manipulated or not real figure for the everyday person. But the figure I pointed to today was actually monetary inflation, and I'll use the US because it's the reserve currency, is approaching over the last 11 years about 13% a year. So what I'm saying there is the supply of money in the economy is growing by 13% a year, not the 2 or 3% consumer inflation. The money supply is growing heaps, and the long term average in the US is actually quite high anyway. It's about 9.2%. So you think about that. If you're trying to maintain your wealth or grow your wealth, not only you don't just need to beat the CPI inflation figure, whatever that happens to be, which is very high right now, but you really need to keep it in line with the monetary inflation, the growth in the supply of money, and that is quite hard to do. You know, if we're talking like 13-14% a year, how can you do that? Now, in today's piece, I identified over the last 13, 14 years, there's only like 2 or 3 asset classes that have managed to do that. And one is tech stocks. Large US stocks, like the biggest ones, are just on that 13% average return figure. And then you've got, in more recent years, gold doing quite well, and Bitcoin over the last decade has been clearly one way to preserve your wealth. But your point earlier was that in this system of money we've got, you're forced to become an investor because you can't save money in the bank, and that's quite a radical thing. If you think about history, what did pirates used to do? They used to steal gold, didn't they? They used to store money. They used to bury money on treasure islands and come back 10 years with a map and try and find it, and that gold would be worth a lot. If you did that today. With dollars, with cash, you'd come back, 30 years and it would be hardly worth anything. And I wrote a story about this in Crypto Capital the other day. Some guy found a roll of notes under his house in America that were buried from 1934, and it was like $14,000 worth, which at the time would have been a whole bunch of money. Today it was worth $14,000. Not a bad find. I'd be happy to find it if I was digging up my garden, but it was nowhere near the value it was back in the day. So your point was you can't save money, even with interest. Even if you're putting it in the bank and earning interest, it's not enough to keep up with monetary inflation. Therefore, you're forced to become a stock market investor, a property investor, or a speculator in other high growth assets like tech stocks. And what we're seeing is that is what people do. People invest via index funds, via ETFs, and they're not really caring about what they're investing in. The stock market and property markets, to a degree, have become savings vehicles because you can't save in cash. So you've got to store your wealth somewhere else. So that is distorting markets. People in Australia wonder why house prices have gone up so much and why no one can afford a house. It's a direct consequence of money being debased and you can't save in money. So people are forced to look for other options. Investment properties have tax advantages and other things, and they have been good store of value assets. Whether you think the fundamentals are right or not, they've been good store of value assets for the past 2 decades or 3 decades in Australia. So that is the situation we live in. That is the economy we live in, like it or not. And what will happen going into the future? That's the question. Do you think governments and central banks will let these things collapse, let these store of value assets collapse if there's a crisis? I don't think they will let them. I think they will not even wait for the crisis. They will actually try and get ahead of it, because what they'll be doing is they'll be debasing the money in order to keep these values high. And there's a side consequence to that as well. If you think how much debt governments around the world have, sovereign governments have, I think, again, take the US because it's the reserve currency. I think they're adding $1 trillion worth of debt every 100 days right now. It's nuts, and it's only been increasing exponentially. How can they get rid of that debt? They can default, but again, that's the end of the fiat currency system. Or they can debase it. This is the trick as old as time. Henry VIII did it. I think the Romans tried to do it. You debase your currency, and the value of your debt in real terms comes down. And so I think to a degree, a lot of this inflation is a deliberate action. They know what they're doing. The trick is to try and keep people thinking, oh, we're trying to fight it and we're trying to get rid of it. But we'll see. Actually, we'll see this Wednesday when the Reserve Bank meet. They're going to meet and decide on interest rates in America. And the debate right now is either going to do a quarter point cut or a half point. It'd be interesting to see if they do the 0.5%, because that will be a massive move up in liquidity, again, which devalues the currency more, and that could cause asset prices to spike.
And the interesting point that you've made in the article today for me was, 30% of for gains in the stock market sounds unattainable. It's sort of like, if I need to achieve that every year, then I'm probably in trouble as an investor. And yet your point really is that if it starts to happen and everyone's making 30% a year in the market because we get this melt up, is probably a sign that something's seriously wrong. And, it's a sign that you might be making these gains, but are they real? Are they, when you get back to your day-to-day life, you might be thinking that you're rich because of your gains in the stock market, but that might not actually be playing out in reality in terms of your cost of living, the housing costs, and so on and so forth. You used to be a financial advisor, which meant you had to take a really holistic approach to people, not just their investment side, which is what you and I focus on more now. It seems to me that that's going to be an increasingly difficult job, whether you're doing for yourself or whether you're a financial advisor, because it's like trying to build a house when the number of millimeters in a centimeter keeps changing over time, right? There's no fixed point of reference. There's no way to think about the financial future when inflation is happening, and even 30% gains in the stock market might not be great, and valuations might be completely out of kilter in property in the stock market because everyone's saving desperately in asset markets instead of in money. How would you even tackle someone's personal financial situation in a time like this?
Yeah, and you're right. It makes the job of planning for your future very hard when markets aren't reacting to economic the economic environment, they're not reacting because investors are looking at the economics. They're reacting just or mainly to a debasing currency. Because how do you account for that? Like you said, for example, when I was a financial advisor, you would get someone coming close to retirement, and you would maybe make their portfolio a little bit more conservative because their wages were going to stop, and they had to rely on a more steady income stream. They had less tolerance for the ups and downs of markets. And you'd maybe buy stuff like annuities, or recommend they buy annuities, which are fixed term, like term deposits, essentially fixed term income streams. And look, in a good year, I remember, I think before the GFC, you're maybe getting 7% per annum return on that, and you're eating into a bit of the interest and taking some capital. Now, think about that, trying to do that now. You used to be able to say, well, you make some calculations on how long that would last you. You're retiring at 65. We put a bunch into an annuity. Maybe we have a little bit of stock market exposure and a little bit of other assets. And we could reasonably calculate that will see you for the next, 25, 30 years if you live that long. And you might have other assets elsewhere for inheritance purposes. Doing that now, if you look at the long-term return on bonds, which are sort of like annuities, your money's going to go, in half that time in terms of its purchasing power. So how are you going to calculate for that? How does a retiree plan for that? Because their only alternative, like I was saying before, is the tech stocks are happening to be one of the only asset classes which are sort of taking some of the debasement and making gains from that, because that makes sense if you think about it. Tech stocks are deflationary, so they manage to suck up that liquidity because they're growth as well. So they've got these dual functions. But imagine being a retiree and having to invest in Nvidia right now, which has gone up massively, then down massively, and up. You can't plan your life. You can't plan your future income streams. So the whole point of the gist of the article is that why this is wrong is in the bid to stop volatility, which is what central banks and governments are doing by debasing the currency, they're creating volatility everywhere else. They're creating volatility in purchasing power. They're creating volatility in your decision making as an investor, because you're not just looking at companies now, you're looking at the currency and trying to work out how much is that going to be worth at some point in the future. And then you're even getting social volatility on the back of all this, because the economic cycles give people chances to buy in cheap and potentially sell at more expensive rates. That's very hard to do now. You look at the trends, especially from young people, maybe towards more left-wing ideologies, is because they can't afford a house. That's a result of suppressing market volatility, but you've created volatility in society, and these are all natural reactions. So yeah, as a financial advisor, I'm glad I'm not in that industry now, because that would make it very hard. Sorry, just got a street screaming child just come home. I don't know if you can hear that. Yeah, so I think that my point as an investor, it's very hard to do. Diversification is one of the things you can do that, and I think right now as an investor, you need to look at hard assets, gold, Bitcoin. You need to have a portion of them in your portfolio to at least provide you some protection if the liquidity taps don't stop. Then I think the hard assets, we see it with gold right now, it's at record highs, and it's had a great year. It's up 23% for the year. Bitcoin, very volatile, but it's up 40% for the year so far. And I think having a portion of these types of assets in your portfolio at least give you a hedge. They give you a hedge against the ongoing debasement that hasn't really stopped since the GFC. It's just fed into the economy in different ways. Sometimes it's through asset prices. Sometimes it's through volatility suppression. Sometimes it's through bailouts. Sometimes it's through the price of goods and services, like we're seeing now. But they're all symptoms of monetary debasement, just in different formats.
I want to give a quick example of what we're talking about here, which popped up actually on my Twitter feed this morning. The German stock market is up 50% since 2017 and making new all-time highs, while German industrial production is 15% lower than at the end of 2017. So we've got this divergence between what's happening on the ground in the real economy and what's happening in stocks and financial markets. I promised to ask you why you've identified now as a time to be worried about this. What made you write this article today?
Look, I suppose it's because, and this was the lead to the piece, was about Nassim Taleb and his whole black swan thesis of, you need to be prepared for unexpected events. And there's always doomsayers in the market. Ever since I've been in markets, there's always people calling for the next collapse. But I have noticed in recent times the voices of that have grown louder. There's a lot of things in a lot of areas that are wrong. There's Japanese carry trade dramas. There's burgeoning government debt, which is going nuts. There's deficits all around the world. There's social problems. There's political extremism, even coming from governments. Misinformation bills, and I say even from governments. Probably that's where it always comes from. But misinformation bills being introduced in Australia tries ways to try and curb freedom of expression and free speech in the UK and elsewhere. So there seems to be a lot of negativity out there, and even a little bit more than usual. And yet markets are near all-time highs. So I wrote the piece because I was thinking of that dichotomy of, all right, so if you're going to take an external view, you could say, look, we're coming for a big crash, and I've seen a lot of comparisons about 2007 and today saying, all these indicators are saying we're going to have a big crash, and yet markets aren't reacting yet, and maybe they will. But what might happen is if everyone's seeing something happening, the nature is of governments or central banks to react before it happens if they can. And my thesis was maybe the black swan in this event is not a crash in markets in nominal terms, but maybe a melt up in nominal terms, but still a debasement in real terms. And so that was the thesis. And I could be wrong on that. It's just an idea, but it seems to be an idea born of behavior before the GFC, but ever since the GFC, it's been a behavior to try and suppress volatility, to inject money into the system to stop failures happening, which doesn't make the system more resilient. It actually makes it weaker. And with an election coming up in the US as well, I can't see the powers that be in America will have any tolerance for a big market crash anytime soon. And yet there's a lot of indicators, like you mentioned, Germany. Germany's in the process of catastrophic deindustrialization due to a series of bad decisions around energy and other things. And yet their stock market's up. So that's a prime example of things look good if you look at a chart of the stock market, but the reality is on the ground, things are really looking bad. And I'm wondering if that can happen in our markets and in global markets, and if that is the real black swan. And I did give the example in the piece today of the Weimar Republic in Germany, which again, back in the 1920s, when things went wrong there, the currency was getting debased massively, and yet the price of everything, the markets were going up. People were buying land, debts were getting wiped out because the nominal value of the debt was worth zero, and people were even buying pianos. The quote I gave in today's piece was even non-musical families were buying pianos. So in order to have something, a scarce asset that could store some value. And so I think that today's piece is about that idea of, if currency, if the preference is markets collapse or currency is going to debase, if that's the two choices we have, my feeling is policymakers, central banks, governments will go for the debasement of the currency. And if they see something bad on the horizon, if they see things are getting worse, they will try and get ahead of that by printing more money, injecting liquidity into the system, reducing interest rates, finding other devious means of supporting asset prices like currency swaps and other things that they can do. And that might mean that we live in a time where there's economic strife, and yet markets are going higher, and people won't understand it, and the doomsayers will be confused. But that is, at least it's an idea worth having in mind.
Other than grand pianos, what investment ideas do you think benefit under this thesis of yours that is one of the few ways to explain what's going on in this divergence between markets and reality on the ground?
Yeah, so like I said, like if you're thinking about this as a terms of infinite fiat, infinite money potentially, then you need to look for the opposite of that, which is hard assets which can't be created at will. And you're seeing that in gold markets already. Gold markets are touching on new highs. I saw a report last week that said the Saudi Arabian government bought a lot of gold. We've seen reports all year that the Chinese government's been buying gold, and that's a sign of less confidence in US dollar as a store of value, because in the past they would invest their surpluses into US treasuries. The fact that they're diversifying into gold suggests they are looking for other places to park their money. Tech stocks, I'm a big fan of AI as a real revolution. Not everyone agrees with that, but I think that will take place. Well, the pathway is a bit maybe unclear, but I think over the next 2 or 3 years, certain AI stocks will come to dominate certain industries. And if we look at the history of tech, we know that tech monopolies emerge out of these moments, like what happened with the internet. And tech monopolies are very viable things. Google, Microsoft, even been around for decades, still got a monopoly on Microsoft Word and Excel and all those other products. So I think strategic buying in the right kind of tech stocks makes sense. Maybe not as a catch-all, but looking for stocks in technology that are winning this AI war. And then, of course, the last one is Bitcoin. To me, Bitcoin is a new form of digital gold. It's an asset you can hold in your own wallet. No one's custodying it for you. You can transact with it at will. You can take it with you anywhere in the world. It is a true self-sovereign asset with a fixed supply. It's getting more scarce by the year. And last week we saw Michael Saylor, who's the MicroStrategy CEO. He's just bought up another, $1.1 billion worth of Bitcoin, and his company, which has been doing this Bitcoin treasury strategy for the last 4 years, is one of the best or the best performing stock over the last 4 years, and only because they've been buying Bitcoin at tops and at bottoms, just continuously buying it. And they've grown their balance sheet from something like they've grown from a $1 billion company to something like a $29 billion company today. And I think the lesson from that is those 4 years is if you've got a saving strategy, if you've got some allocation to Bitcoin, that is your all-weather asset that is leveraged to currency debasement, but also technological innovation as well. So it has those dual uses.
If I were to sum up your ideas here, it's that during an inflationary period like this, one way to outperform inflation in order to grow your savings and wealth is to invest in quite high-risk assets, such as Bitcoin and these tech stocks. The idea being that, that during these melt-up booms, they are not just going to match inflation like you might expect the wider stock market to, but to outperform. There's certainly one way of doing it. You're also pro gold, I believe, which would be in like a low risk way. That's why you said diversification, I think, earlier on. But these high risk opportunities are certainly the way that allow you to actually get ahead of inflation and continue to grow your wealth. That's what makes them so interesting. I'm going to close here by saying what I think sums things up. Governments and central banks are going to sacrifice the value of money instead of allowing markets to crash. In that sort of environment, the risk of a catastrophic market melt up is something that investors do need to actually worry about and to position themselves to profit from or to benefit from. I hope Ryan and I have made you aware of this risk in this video and given you some ideas on where to look for solutions. To find out more, check out Ryan's article on our Fat Tail Daily website and subscribe for free to receive more insights about market melt-ups and similar topics. We talk about all sorts of things at Fat Tail Daily. If you're already aware of all of this and you're already worried about it, I can only encourage you to watch our presentation called Decade of Decimation, which takes Ryan's ideas and others and packages them together in a more comprehensive view about what lies ahead for Australia and what you might be able to do about it. Ryan, thanks for coming on, and to everyone watching at home, thanks for watching. Before you go, I have another announcement. Our publisher Woody has promised me a $10 million bonus if I can double the number of subscribers to Fat Tail Investment Research's YouTube channel. So please like, share, subscribe, and send this video to all of your family and friends. Let's give Woody a nasty surprise when he comes back on the 23rd of September.